Nestle's dramatic decision to slash 16,000 jobs has sent shockwaves through the industry, but it's also sparked a 7% surge in its stock price. Is this a desperate move or a bold strategy for survival? Let's dive into the details and uncover the truth behind this controversial decision. Imagine a supermarket shelf in Encinitas, California, lined with jars of Nescafé instant coffee, a staple in Nestle's vast portfolio. This iconic brand, along with others like Nespresso and Kit Kat, has been the backbone of the Swiss giant's success. But as of September 2nd, 2025, the company is making headlines for a different reason. New CEO Philipp Navratil has announced a massive job cut, targeting 12,000 white-collar positions and an additional 4,000 roles over the next 2 years. But here's where it gets controversial. Is this a necessary step to streamline operations, or is it a sign of deeper troubles within the company? Nestle's shares jumped 7.2% on Thursday, a clear vote of confidence from investors. But this optimism comes after a turbulent year for the company. Under former CEO Laurent Freisch, Nestle had already initiated a cost-saving program worth 2.5 billion Swiss francs, $3.14 billion. Navratil has now accelerated this to 3 billion Swiss francs by 2027. And this is the part most people miss. While the company reported a better-than-expected organic growth rate of 4.3% in the third quarter, it's still battling an uncertain consumer landscape marked by U.S. tariffs and rising raw material costs, such as cocoa and coffee beans. One bright spot is the return of real internal growth, RIG, to positive territory, up 1.5% in the third quarter. This rebound, driven by growth investments and easier comparisons, contrasts sharply with the second quarter's miss, which had caused Nestle's shares to underperform. HSBC analysts had predicted this turnaround, citing easier comparatives and reduced elasticity effects from price increases. However, here's a bold interpretation. Could this recovery be short-lived if global economic conditions continue to deteriorate? Despite these gains, Nestle's business in Greater China remains a weak link, dragging down organic growth by 80 basis points and RIG by 40 basis points. The company assures that new management is in place to transform the region's performance. John Cox, head of European consumer equities at Kepler Cheuvreux, notes that Nestle's strategy of focusing on winning products and turning around underperformers has driven better than expected third-quarter sales. But is this enough to sustain long-term growth? The past year has been particularly rocky for Nestle. CEO Laurent Freisch was ousted on September 1st over an undisclosed romantic relationship, and Chairman Paul Bulck stepped down earlier than planned due to pressure from institutional shareholders. Navratil, formerly CEO of Nespresso, has pledged to accelerate the company's strategic direction and value creation plan. However, a counterpoint to consider: can a new leadership team truly restore investor trust and navigate the challenges ahead? Analysts from Deutsche Bank suggest that long-term investors will need more reassurance from Navratil, who is relatively unknown to the market. While the initial focus will be on volume growth recovery and the Chinese market, investors are also eyeing updates on the partial sale of Nestle's struggling water unit, its underperforming vitamins business, and plans for its 20% stake in L'Oréal. Here's a thought-provoking question. Is Nestle spreading itself too thin, or is this diversification a strength in an unpredictable market? In his Thursday statement, Navratil emphasized the need to move faster and allocate resources more rigorously, prioritizing high-potential opportunities. But what does this mean for the future of Nestle? Will these cuts and strategic shifts position the company for long-term success, or are they merely stopgap measures? Share your thoughts in the comments. We want to hear your take on this complex and evolving story.